Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, April 8th, 2022. It is 11:24 a.m. Eastern Time as I'm starting the video, and we're going to take a look at some trade ideas, primarily the precious metals. I might throw in natural gas. It looks like a setup there as well, time permitting. But let me just go over some of the precious metals. We'll look at gold, silver, platinum, palladium, and the euro US dollar, because those often affect those trades. This is gold. This is a long-term chart of the ETF GLD. Shows you kind of the history over the last decade or plus, and you had this bull market right here, and nothing goes straight up. You have bull market corrections along the way, and we peaked right back there. That was in 2011. Entered a bear market, which ended in the end of 2015. It was December 2015. We bottomed, had nice divergence. Everything else, all the signs were in place. That's when we got bullish and long gold, and milked it as a trend trade most of the way up, right up here to the top. Then we hit that previous bull market high. It was a significant reaction high, and again, so you can see this is a bull market, bull trend in gold. And I've talked fundamentally that I think gold has been slighted somewhat. We've seen very, very strong performance. We're in a hyperinflationary environment, and industrial metals, of course, just everything, just commodities across the board have been going up. Now, gold's been going up, but especially over the last year or so, it's been underperforming a lot of other things. So from that aspect alone, I think there's a fundamental case to be made. But of course, bottom line, say what you want, where you think something is going to go. As of now, this is still, there was our bottom. There's all our lows. That's a bull market, a bull trend, higher highs and higher lows. Now all we have to do is take out those the previous highs. We've been tapping on it recently. We tested it there, had a brief overshoot and fell back. And that's where I mentioned at the time closing out all my long-term gold positions and gold, silver, and the miners and all that, and even shorting, expecting a considerable reaction at that point in time. We got it. So we've consolidated over about the last couple of years, and recently made another run at it, and need to just pop it. So basically the highs, you see, you turn off, well, you don't need to turn off the lines. There's your previous high back from early 2020. There's the recent high, and you break above that, it should be blue skies. The divergences, there are some divergences, and we'll monitor that. I don't like breakouts to new highs with divergences. They often fail, but in a bull market, divergences can and often do get burned through. But let's look at some other things here. So that's bigger picture stuff. And again, lately, and I've covered this, we've been kind of grinding around sideways. I just jumped down to a 60-minute chart. And here, let me turn off all these lines. I haven't updated that in a little bit. You can see pretty clear here that we've just been moving sideways right there in a little trading range. And this is just like that GC, gold future 60-minute chart I've been covering. So we need to pop above there to run. Obviously, a downside break is not going to be bullish. It's going to be bearish, especially if it's anything more than a whipsaw. I'll get to GC in just a second. But so I wanted to say that's where we're at. This is a daily chart. It's a little messy. Let me go to GC, the gold futures. Like this is my preferred proxy for gold. You have this, as I've covered recently, we've been in this trading range here recently. We had one little pop to the top that failed, then took us down to the bottom. And just right here, what was that, on the 29th? I put a hard buy out, throughout gold and silver, both as hard buys. Now, they haven't exactly rocketed. They're still up from that level, but there you can see, look at this level right here, 1920. Look at all those reactions on that level. It was resistance back there, support there, and with a couple little false stop clearing runs, this is what happens. Powers that be play these games and pop stops there, and turn around and short it, or whatever you want to say. These are the charts, these are the levels, and they're hard to deny or even miss. So that's it. 1957 is where my line's at, so we need to pop that. 1958, whatever, and pop it and hopefully get a sustained breakout and run. I think that'll be the case. My next target's 1982 right there. And then after that, it starts to get pretty thin as far as resistance. You got a couple reaction high there, and there's that big. Remember, this is a 60-minute chart. That's that same multi-year, multi-decade high where gold has tapped now 3 distinct taps and rejections. So breakout above that is going to be bullish if and when we get it. That's kind of longer term. Near term, if you're an active trader, boom, pop 1957, take you up to 1982. and then maybe around that 2020-ish level. And sounds like I'm reminiscing on the years here. So 1982, 2020, and then really run at the highs. Silver, I've been partial to silver lately. I'll trade them both, but I've been overweighted silver. It's been my preference for the last at least last several months here. Both fundamentally and technically. It's going to, for the most part, follow gold. There are times silver will under or outperform gold, but for the most part, it'll follow it. So to be bullish on one is to be bullish on the other at most points in time. Yeah, it was a big support. There was a hard buy I gave you a couple weeks ago right there. Nothing big. We're up. We're still remained, even on the pullback, we remained above that buy point. And so now I want to see this line pop here, the downtrend line. And then you got a nice resistance zone there, about 25 up to about 25 and a quarter. Pop that. Next resistance is around 25.67, then 26.38, and then boom, you got that big important high. And so that's near-term targets. Long-term stuff, if you want to just hold it as a long-term trader, especially if that gets broken. And keep your stops here. If you bought it there, you could have a tight stop, or you can give it a little more room. Again, the nature of the beast in this market nowadays, with the algos in the high frequency trading, and in the big trading desks, stop raids are common. So it's not unusual to see a well-defined support level get broken, only to see a reversal. Now what you do there is you don't necessarily buy the breakdown. You can do it. It's very aggressive. But you can wait to see a recovery. If you're just sitting back, or maybe you have a partial position and you're going to give it a little room, it's if they break down and then you make a recovery back above there, then you have at that point a false breakdown, aka bear trap, and that's usually when I'll enter or add to a position. So that's the outlook for gold, silver. Of course, silver, if you don't trade futures, that was SI. The silver futures, you can trade SLV. You can use the miners, of course. The miners will typically outperform the metals. The only time they tend to underperform is during periods of very strong stock market sell-offs, because they are equities and they get dragged down with it. Other than that, and that's not a set ratio, it's not 1.2 or 2.0, but they do tend to have, again, go up more when the metals go up, and the miners tend to fall more when they go down. Sorry, I had to pause it for a phone call there. This is what it looks like on the weekly chart right here. Silver, of course, I showed you gold challenging those multi-year or really all-time highs. Silver's still below there, so there's some potential catching up to do. But again, when the metals run, silver often tend to run more. Look at that beautiful bull flag back there on the weekly. Look at that, how it played out. That measured targets to move up to the flagpole. There was your flag. Final thrust up, blow off top. And then the bear market, and then silver, unlike gold, which bottomed back right here, silver had one more, really went down, and that's why it outperformed. It got oversold, really thrown out when COVID hit right there, and but it quickly recovered that low, and it's been walking its way up. So yeah, that happened in a blink of an eye. That was literally, this is a weekly chart. There was one weekly candle, a single weekly candle. It's that red one right there we closed below. The next one we regained it. So for all intents and purposes, if you closed your eyes or didn't open the computer for that week, then silver really has a triple bottom there, because again, that next weekly candle closed back above there. So again, this is when gold started its bull market, and that's effectively silver. Like gold, they both consolidated for a while, but then they broke out. This was a big breakout right here, and this is, I view it as bull market consolidation. It's been moving around, and you can see if you look at it this way, again, we're on a weekly chart, so this is bigger picture stuff. It's not going to affect your trading today, tomorrow, or next week, but in the coming months to years, if silver can power on through here, just like gold, take out the recent highs, it's going to break out of this trading range. And again, I view these, like I use the analogy, it's like coiled spring building energy. And so if you can get upside break, great. Downside break, obviously not good. I don't have support until all the way down to about 1758. The bottom of that range is about 2050, and that would be about a 14% drop if so. But right now you've got maybe it's not the best. The flag's a little bit long, the flag for the relative to the flagpole, but you do have an impulsive leg up there in this flagging type action. So if we could pop now, pop soon, that should take us up to the top of the range thereabouts, or maybe even to run at those previous highs. So that's kind of bigger picture stuff. Silver 60-minute chart. You've got some divergences here. There's your divergence there, right? Yeah, you can draw divergence like that. But I'm going to show you a couple other things too in addition to this. So that's silver. There's SI. I already showed you that. The metals tend to move inversely to the US dollar, meaning dollar down is bullish for gold. Now they can do their own thing, and that's what I've been noting lately. The dollar's been rising, and that's because we're the most bullish, kid on the block right now. I'm talking about, or Powell's the most bullish kid on the block, with the Fed, already raising rates and talking about raising more. And no, you don't. It doesn't matter. The Bank of England was ahead of us, but that doesn't matter. They don't move the needle. It's the euro is 57.6, I believe, percent of the dollar index. The yen is 23, something like that, the second largest. So it's really the euro that's going to move the dollars. Who's more bearish or hawkish or dovish, the ECB or the Fed? And lately it's been the Fed, and that's why you have the dollar's been rising. But you can see here we've been building. Now we have some very clear and clean negative divergence. This is a 120-minute chart, meaning every candle is 2 hours, 6 months of trading history, and there's a divergent high right there. There's a nice clean-up trend line. Remember, divergence is not a sell signal, merely an indication that a trend reversal is likely. Your sell signal will come on a break of that. You do have some support right there. Let me put that line up on there for both my purposes and yours. There's some support right there, about 99.34, and if and when that gets taken out, as I suspect it will, and I think we'll go all the way back down here. That's my target for the dollar. That trend line is going to come in about when we get there. If we do, and that'd be a nice drop. That would be it should be a very give a tailwind to the gold and silver and potentially some of the other precious metals I'm going to cover in this video here in just a second. So that's it. Let's get that sell signal, break the trend line. That would be your sell signal. Secondary sell signal would come on a break at 99.34. And again, the euro is just pretty much an inverse. Now I jumped down. This is an hourly chart, 60-minute candles. Okay, we're just looking at a 2 hour, so we're looking at 6 months, 2 hours candles. So this is just zoomed in a little bit. But here's the euro. So we broke out here. I pointed that out a few weeks ago. I thought that rally would stick. And they faded it. It was a nice rally, and it did have, as I pointed out at the time, little small divergences. So those divergences played out for a bigger pullback than I thought. But we've come full circle. So we corrected. We pulled back more than I thought we would. That gave a little bit of a boost to gold and silver. But here's where I'm going. Gold and silver have held up very well. So I consider it very bullish if gold and silver are going sideways. Most people see gold and silver stalling out, but I see bullish because when the dollar is rising, as it has been, and the euro is falling, the whole reason that the gold and silver moves inversely to the dollar, they're priced in dollars. I talk about this all the time. It's very simple. If the dollar drops 10% in value, it takes more US dollars to buy 1 ounce of gold. And that's the gold we're trading here. We're trading the futures, trading GLD. Yeah, if you're in Europe, your gold's priced if that's what you're trading in euros. But as far as here in the States, and that's a big, of course, dollar is the world's reserve currency. So with that being said, when I see a pretty strong rally in the dollar, a pretty strong drop in the euro, but yet gold is either going up or going sideways or maybe going down but not that much, then that tells me that there's overwhelming demand. There's normally gold should be dropping when the dollar is rallying hard, and when it's not dropping, it just means that there's more buyers than sellers at that point that are offsetting that impact that the currencies normally have. Now, that being said, so if that holds up, and right now the supply demand dynamics are at very least neutral or net positive, again factoring out the rise in the dollar, that tells me that if this breaks out, which I expect it will, and it's going to coincide, by the way, with a breakout in the dollar I just showed you. So when the dollar, or a breakdown in the dollar. So boom, we pop this, you got resistance here at 109.38, right above the trend line. That should rush us back up here to that. This was my former first target when we broke out down here. That was my first target, which was hit. We got a reaction. We broke above it, but then the breakout failed with that divergent high. So that's again my next target, just as it was back here. And then if and when that gets taken out, I'm still maintaining that same target it was back there, about 113.26. That would be a nice run in the euro, coincide with a nice drop in the dollar, and should do the trick of breaking gold out above these levels that I just went over earlier in the video. All right, so you've got, I gave you, I think I did, I'm going to give you, I know that not everybody trades the futures, so let me give you, I didn't mark this chart up, I haven't gotten really updated this in a while. These are old lines down here, but you can see kind of the same thing. There it is. I'll just update the lines. This is just like that GC gold futures chart I showed you. There's the trading range we've been in. There's the little false breakout to the upside that we had that failed. There's a little false break to the bottom. There's a hard buy I gave you on gold just a week or two ago. And there's the level that needs to pop, about 182. Targets just correlate with what I gave you on the futures there. It's not hard to take a chart. Even if you don't trade futures, investing.com, TradingView, TD Ameritrade's Thinkorswim platform, they will all give you futures charts for free, real time, I believe. I know on investing.com, and of course, if you know TD Ameritrade, if you have an account there. And many brokers, other brokers as well. So what I'm getting at, if you don't trade futures, you can still chart the gold futures and the silver futures, replicate the lines. And again, by doing it on your own, using those charts, you're seeing trades that occurred you're not seeing here. This is 9:30 to 4 p.m. trades, but gold's trading around the clock, around the world, as silver is. And so that's why by charting the futures, you can pick up some additional trend lines, support and resistance levels that might not be so obvious, or you might not even see at all on GLD. So that's that. I'm not going to spend any time right now on the miners, because again, the miners are simply a leverage play on gold and silver is what I say. They're going to go up, typically up more than gold and silver during a rally. Not necessarily every single day. There might be a day that gold is up 1% and GDX is up, 0.8, but I'm talking the trends. All right, so that's gold. And there's your levels. Just kind of more so, I'm more so looking for a breakout. And just I'm already long because I've put a hard buy a couple weeks ago, but may add to my positions there and just kind of let it ride for the time being. So I'm showing you some near-term targets, but more so levels that I'm looking to get taken out and hold on for what I think has a potential to soon be a breakout to new highs. SLV, the silver ETF, I just redid my lines right there, as you can see. It's Gap City here. Because why is it? Because they're those futures are trading around the clock. 4 p.m. silver and gold keep going, so you're going to get gaps almost every single day. But the traders will use those gaps as well. And so anyways, this is a bullish falling wedge. Let's not overthink this one. You have a bullish falling wedge pattern, complete with positive divergence. If you break out, you also have some price resistance there, give or take around 20, a little hair above $23. And a breakout, the widest part of the wedge is your measured target. Add that to where the wedge breaks out. I'm just rough drawing the lines. You can duplicate trend lines and add them there. That should take us up somewhere in there. And then quite possibly beyond. Remember, we are in a bull market in the metals until proven otherwise, until we start taking out some of the major reaction lows to the downside on the daily and weekly charts. At that point, you might be able to say, well, the bull market's over. At this point, anybody can say what they want. We've been in a year plus long consolidation range, but I'm still taking the view that it's a bull market consolidation, and we're probably going to break out at some point, most likely this year. And maybe sooner, maybe later, hard to say. But what I can say, those are the levels to watch, and then when we do, that should be net bullish, longer term bullish. Okay, and now just let's talk. We're not going to go through every single, just the big ones. I usually cover gold, silver, platinum, and palladium. Palladium, I mentioned, I threw out as a trade idea a couple weeks ago. Told you I bought off this divergent low right here. This is PA. I'll get to the ETF for you in a second. That's PALL. But the Palladium futures are PA. You had a well, you can see all the levels. You had a uptrend line there. You had a little blow off top right here. It was actually a divergent high. These lines never got changed. I was tracking the divergence at that time, and we went on to have a blow off top. That coincided with the invasion of Ukraine, because Russia is I believe, still the second largest producer of palladium in the world, and because of that, it caused palladium prices to shoot up. But just like gold or crude oil so far too, was an overreaction, and at least a near-term blow-off top. The divergences remained on the RSI. They got taken out there on the PPO, and that's what a parabolic run. I always talk about this. I use a saying, parabolic runs typically don't end well. That was a parabolic run. Anybody that jumped on and trades by reading headlines, watching the evening news or reading Bloomberg or the Wall Street Journal, and bought palladium after that point, well, guess what happened? You bought, you did what the masses were doing at the time. You bought, now you had a 40% drop, lost 40% of your money if you bought the high on palladium. That's why I don't chase parabolic tops, even though they can keep going. That's when you want to be looking to sell, if anything else. But of course, then the technicals took over. You had a trend line break right there, consolidated for a while, dropped down, took out this longer term trend line there, back tested it right there, breakdown back test, set up a little triangle pattern there, which could have went either way, but it broke to the downside, so that was a sell signal, walked its way down. And then most recently, as I pointed out a week or so ago, put in this divergent low, which is bullish, and has been walking its way higher from there. This downtrend line on the triangle, if I extend it, it's coming in about where we're at, so we just hit resistance. I'm sitting tight for now. I added on platinum today, and I may just take profits on this. I think there's more upside, most likely, but my convictions aren't strong. I would not be adding to this. I just wanted to give you an update, and you can see some levels. If we can really get going again, that would be, let me give you one more potential target there. Again, this is more of an update for those that took it. Where we're at right now, we had a nice thrust up today, and we took out that recent high. So at this point in time, you really want to see if it pulls back a little more. You want to see it hold above right there, these recent highs, 23.44. So you could put a stop right there, and you're still very profitable. Minimum, if you grabbed it anywhere near that divergent low, you've got support right here. That's the last, that would be my bottom stop right there, 21.68. But let me show you, let me get to PALL, and then I'll get to platinum for you. PALL is the Palladium ETF, and you can see same thing, positive divergence, 60-minute chart right there. At resistance, I can't remember. I probably would have showed you if I didn't. If I showed you this chart when I mentioned it last week or so, I would have had these levels because I haven't changed them. That's 230.85. Boom, we hit it today, resistance. And I also showed you the downtrend line on the futures. There's a gap overhead. Maybe at this point just trail stops up if you're going to let it run. That's what I might do. In daily chart, you have a little more upside to. These are old levels. I mean, gosh, that was resistance back here. We had a short trade on it. We nailed that top right there, shorted it there, and the thing dropped big, and put in this divergent low at the bottom, and big run up. The whole Ukraine thing right there just caused that parabolic blow off top, and that's where we're at now. But again, fundamentally, we are in a hyperinflationary environment, which is net bullish for metals, especially industrial metals. This is technically a precious metal, but it's more of an industrial metal because the primary use, the biggest use of platinum in the world is in emission controls for cars. Now, cross currents there, right? The automakers I pointed out recently are going down. New car sales, even though there was demand, there's still shortage of cars. They're just not moving a lot. There's hardly any on the lots right now. They're having a hard time. So, you can have all the demand in the world. If they're not getting the chips to build the cars, and they're not building the cars, they're not ordering as much palladium. I don't know, a lot of technical or fundamental cross currents, but let me move on from this. You can see some levels. I haven't really updated these in a while, but let me show you the one I like a little better at this point in time, where if you're looking for another trade idea, and that's platinum, PPLT. Platinum, this is my daily chart. Again, old lines I haven't touched forever. These are lines I've traded off in the past, but this one's still valid. We had support back here, reactions there, little consolidation there followed by a breakout. We broke down there briefly but regained it. And so it's a level we've chopped through a few times, but I still consider it support, 90, and we just hit that recently. I'm going to get to the 60-minute chart in a second. You have the PPO starting to curl up here, and I look for that on the daily chart. These bullish and bearish high level or low level bullish PPO crossovers, high level bearish PPO crossovers, they tend to coincide with tops and bottoms. One crossed over there just shortly after the bottom was in and got you in long for this whole trend. Got that one, that one ended up with a divergent high. You had a bearish crossover and then one more at a lower level, so that gave you negative divergence, then the drop. Low level bearish PPO crossover right here, caught that trend. So now it hasn't happened yet, but you can see that the slope of the line has now turned positive. It's curled up, or at least flat, slightly positive. Yeah, it is pointing up a little bit. So bottom line, if we can get a little more upside, you're going to get that bullish PPO crossover, and that's typically good trend or swing indicator right there. 60-minute chart. You got this nice 60-minute bullish falling wedge, complete with divergences right there. Popped it today, and even before the video started, I had added this line here, 91.50. Actually, maybe that line was there. Yeah, it was my former. Look at that. First target from this trade back here off this divergent low was the bottom of that gap. Yeah, so I thought I might have added that. I created that line back in September of 2021, and I haven't changed it or modified it since back then. Or no, updated on 12/31. Okay, 12/3/21. A while ago. So that's it. Either way, it's resistance is the bottom line. And you can see it still acted as support right here, then that support broke. So what happened? The wedge broke out, but we hit resistance just a hair above. And that's what I call a BOD line, benefit of the doubt. If I see, which I do here, bullish falling wedge, a downtrend line. Now, I'm in it because I think it's going to break out, and I'll add to it if it does. I'm also going to show you the futures here in a second. But the benefit of the doubt means if you want to play it safe, you wait. If you have two resistance levels in close proximity, wait until the latter of the two is taken out. And then, because some eyes are watching this, other eyes are watching this. And so you might have some sellers step in and sell at 91.50, but when 91.50 goes, that means the trend line would have been taken out already, and then boom, that resistance level. So, and the wedge would measure, up here. I don't have the targets marked, but I'll give you one more right now. If you're going to trade it, right there. I like that level. See some nice reactions about 96.33, or just let it run because you might get some more out of it. You can see what happened the last time we had divergent lows right here and here, and that was good for a roughly 20% rally, and this one was good for a roughly 30% rally. So that says that, hey, based on the pattern of platinum on a 60-minute time frame, you get bullish divergence, you typically run 20-30% lately. So alrighty, the futures, and then we will wrap this video up. PL, or platinum futures, this is what it looks like. Same thing, 60-minute chart, nice, clean. See how you have more lines here? It's a better defined wedge than the ETF I just showed you, because that ETF is only showing what's happening between 9:30 a.m. and 4 p.m., where this is pretty much round the clock stuff here. You've got nice distinct reactions. You have a nice breakout today, impulsive, everything I like to see, but just like the future or the ETF, it got checked on resistance. 985.82 is my resistance line right there. You can see it was resistance here. We broke out, and we didn't just meander around. We broke out and had an explosive move higher, and that will set off this nice uptrend here that ended here with that divergent high. And so boom, that's it. There it is. Keep it simple. I can tell you right now there's two objective entries on this right here on this back test where we're at this point in time. I'm going to zoom in a little tighter so you can see it in the video. There is your breakout. Well, I don't know why it's on bars. I usually use candlesticks, but same difference almost. All right, there's the breakout. Boom, rejection off the first initial tag of that level. Back test. You can buy here on the back test. You can run a real tight stop a little below that 966.38-ish level. You can run a little bit wider stop, up to you. But you don't want to see it fall much back below the trend line. So maybe right there. That's about 960 would be max stop on this one. So step in here, again, up to you, tight stop, or even buy. I'm not crazy about that because you really don't want to see the breakout fail. It can fail on an intraday basis as long as it closes back above. That's good. And then the big level is going to be solid breakout above 985.82. We'll call it 986 if you want to round up. Targets 1002, 1020, 1043. Let me see. I might not have updated that in a while. Let me make sure that. Yeah, we'll leave that there. Oh, maybe all the way up here. Oh, let's just say right now, if you just want to hit and run trade in and out, 1020, that should be a no-brainer, and it'd be a quick, close, almost 5% if that one's hit. Or again, if the charts are constructive, what I like to do in a trade like this sometimes is just, periodically raise your stops or set a trailing stop, ride out the zigs and zags and let it run so you can get a bigger trade out of there. And of course, it's going to help to see the dollar breakout or dollar breakdown and the euro breakout. And if that happens, then that would be an additional catalyst for me to maybe hold on or add to this trade. All right, guys, we're going to wrap it up here. That is the update on the precious metals. And it's really all that stands out today. Here, I'll tell you what, before I end the video, I told you natural gas. More of a setup in natural gas. Where is it? I have two charts. Let me find the other one. One sec. All right, this is it. This is just a 1 month chart, hourly candlestick, 60-minute. So this is the primary trend line right there. This is a secondary trend line I have that I think has some validity there because there's enough reactions on it, including here. We had a couple brief spikes down below, only to recover it again. So what I'm looking at here, natural gas has really run, obviously, again, a beneficiary of the Russian attack on Ukraine and everything that's going on over there. So fundamentally, the case is strong. But again, a lot of that's been priced in. So there it is. You break that. There's your BOD line, benefit of the doubt. And I haven't really set any targets now. I'm not looking for a moonshot trade on it because there's strong fundamental headwinds for nat gas. But things are starting to warm up too from a seasonality perspective. Yeah, Europe's very dependent on Russian natural gas, but it's going to warm up soon, and the markets always look out ahead. Natural gas has its own quirky things. And then if you don't trade the futures, I just want to show you UNG. You can kind of get a bigger picture here of what's going on in natural gas. This is a daily chart right there. This is a strong run here. I haven't even modified that trend line. That's probably a target. Come back down to that trend line. You can see we're getting pretty overbought. There's divergence on the RSI and even the PPO if we turn down soon because we haven't made a higher high yet. And so that's a big divergent high. And so if we swing back down to that trend line, that would be a drop in natural gas. This is, of course, UNG, if I didn't say it. That's a natural gas ETN, probably the most liquid one. About a 19% drop there. So there's your setup. You need to take out the trend line, of course, that I just gave you, and you can replicate it on UNG, something along these lines. Secondary trend line right here. Again, that's your target, roughly there. Give you that same roughly 22% drop if hit. Maybe I'm going to bump that line up right there. 1750 if you want a numerical target. 1750, and the trend line should come in together, about 21% drop if hit. All right, we'll wrap it up here. Again, this has been Randy Finney with Right Side of the Chart. If I don't do another update today, have a great weekend.